Well, it has been a hot summer and a hot stock market when it comes to Canada and the U.S. This morning, investors continuing to digest the latest earnings stories, but also mindful of the trade and tariff uncertainty. Michael Green is Chief Investment Strategist at Simplify Asset Management. Michael, nice to have you back with us. As you look at the charts for the market right now and couple that with some of the headlines that we continue to digest right now, what stands out to you?
Well, I think to me, the most interesting charts that are actually coming to light are the dollar and the U.S. interest rate market. Both of those have been under pressure, rates under a yield framework, and dollar obviously is pressure coming from the institution of the tariffs and the move out of the dollar associated with that in February, March. Now we're in an environment and a regime in which some of those flows have exhausted themselves. The money is coming back into the United States to invest in the stock market. And likewise, tariffs are beginning to shorten up the supply of dollars on an international basis. All else equal, that should be supportive of U.S. dollars and very supportive of U.S. interest rates, despite all the hoopla around the loss of Fed independence, et cetera. I think those are really the key charts that I'm paying the most attention to right now, both of which would suggest some incipient weakness underway.
And just for the record, I mean, obviously, since last Friday's weak jobs report in the United States, a lot of people have been ramping up their expectations that the Fed will cut interest rates come September. Where do you land on that right now?
I think the Fed will likely cut in September. Unfortunately, I think that the residual seasonality that exists within the CPI baskets, it was unfortunately very thrown off by the dynamics of the pandemic and then the Russian invasion of Ukraine impacting the inflation numbers. That residual seasonality suggests that Q4, and Q1 for the CPI are likely going to be a little bit higher than people expect. That may actually prevent the Fed from following through on what it's now pricing in of at least 3 cuts.
All right, and I'll remind our audience that we're going to get a look at the jobs story in Canada later this week, and obviously we'll see what the Bank of Canada itself does in September at its rate decision. Listen, I also wanted to get your perspective, Michael, just on the trade story itself. Every day brings, new complications. You talked about it through the lens of currencies, but what do you think the market is going to? Where do you think the market's going to land on a story which it has felt like, on average, investors have discounted just because of what has happened post-Liberation Day?
Well, I think the most important thing to remember about tariffs is that the immediate reaction, the minute the U.S. starts talking about tariffs, is we immediately jump to something like the Smoot-Hawley tariffs of the 1930s. The positioning of the United States is so radically different versus what it was in the late 1920s and early 1930s when it was the exporter to the world, that to think about tariffs in the same framework, I think, is deeply, deeply misplaced. And so there was an initial reaction in markets where discretionary portfolio managers or discretionary sovereign wealth fund managers made a choice to repatriate funds that supported currencies other than the dollar. It also pressured U.S. assets somewhat more than others. Once you're done with that, though, I'm reminded from the scene of John Belushi in the movie Animal House, right? Who's with me? Well, the answer is nobody, right? Nobody's going to follow through on that. At the end of the day, you need those dollars to conduct business in order to sell to the United States, et cetera. And for all the hoopla around how offended the rest of the world was, look how quickly the Swiss prime minister hopped onto a plane to fly to the United States to address, abusive tariff threats. So the simple reality is the world needs dollars. Tariffs make less of them available. There's a lot of excitement around that initially. And then at the end of the day, the U.S. is not trying to sell stuff to the rest of the world. We're simply taxing others for entry into our markets. It's annoying, it's frustrating, it causes friction, it causes changes in capital allocation, but at the end of the day, the customer is almost always right.
Now, in light of all your commentary around the U.S. dollar, I'd love to talk a little bit about gold as well. As you know, given the influence of gold stocks in Canada, they've been a driving force to all-time highs, and the Canadian stock market continues its record-setting ways today. In light of the fact that probably over the last few years we've had a few storylines tied to gold, but one of them has been governments, countries that have been looking to shift their U.S. dollar dependence towards something else has been seen as a helping hand for gold. How do you feel about the outlook for gold?
Well, I think that there's a couple of factors on gold. I think the most important one is the one you just hit, which is in June of 22, the United States government decided to treat treasuries as if they were an asset that could be taken from other sovereign entities if they do something we don't like. And so the decision to confiscate Russia's reserves had a very notable impact, particularly on China, which began to diversify its holdings and its incremental flow in particular towards gold. That is one of the confusing components of it. It looks like the U.S. is trying to depreciate the dollar. The simple reality is that because we import so much from China, if they're not reinvesting it in U.S. dollars, that means effectively they're selling U.S. dollars and buying gold with it. Once again, the institution of tariffs reduces the quantity of those dollars that are becoming available. Interestingly enough, I think China is beginning to struggle with that. And the last thing that I would emphasize is that because there has been a dispute, a contrary asset to gold in the form of things like Bitcoin, et cetera, and to my knowledge, Canada's deposits of Bitcoin in the Laurentian Shield are quite low. The reality is that the move in gold was somewhat suppressed by the availability of non-dollar alternatives. And so I think all of those factors are now actually coalescing into that period of dollar strength that I was highlighting before.